Given the phenomenal run-up of 7 of the most important tech companies in the world today, many investors are probably wondering if there is still any value left in many of these big tech names, or is it just another bubble waiting to be popped? The SPY is up nearly 18%, while the QQQ is up by more than 40% in less than 9 months. No wonder investors are apprehensive about buying into big tech today. They pretty much make up a major portion of your indices. So in this video, we'll be exploring the current state of the Magnificent Seven, and we'll try to make sense of the valuation, risk reward, and whether they're still a buy or not. So let's first talk about Apple. So from a business fundamental standpoint, there really isn't much to complain about. So the strength and quality of the Apple brand remains as strong as ever. Users in the Apple ecosystem probably have no intentions of switching out, and they continue to print a great deal of cash flow, which is largely accrual to shareholders via their massive share buyback programs. So just take a look at this graph. What else can I say? Just shut up and take my money. However, over the last week or so, there are renewed concerns around the relationship between China and Apple, where China is reportedly banning officials and state employees from using iPhones. From preliminary calculations, a few analysts have argued that the ban is way overblown, as the restrictions would work out to less than around 500,000 iPhones of the roughly 45 million handsets that are expected to be sold in China over the next 12 months. So this figure comes out to around 1.1% of Apple's expected revenue from their Greater China segment. So in Apple's latest quarterly report, China makes up around 17.6% of the revenue contribution. So that means a 1.1% on a 17.6% revenue pie, suggesting that it will be a 0.2% impact on overall revenue. So although the numbers look minuscule on the aggregate, I think a larger problem has surfaced to the top over the last 2 weeks or so, as investors are currently scrutinizing the symbiotic relationship between Apple and China. On top of demand, Apple's entire supply chain is rooted in China's home ground with very little headspace for maneuver. And this reliance is very much reflected during the COVID crisis just 2 to 3 years back. So Apple's response to this? Diversify, diversify, diversify. So they're moving productions elsewhere bit by bit, but let's be realistic. Many of such investments and even the reconfiguring of entire supply chains take time and sometimes take many years. So Apple's dependency on China will not vanish within a few months. Prospective and even current investors will have to get comfortable with this foreseeable future of a tit-for-tat bickering between China and the United States. So you know what else you should get comfortable with? Smashing the like button, of course. Do it now. I'm waiting. On the valuation front, analysts are expecting Apple to not deliver much growth in the coming quarter, but hopefully re-accelerate back to the high single digits in 2024 and subsequently 2025 as well. Intuitively, being the largest company in the world by market capitalization, Apple has hit a certain level of saturation, no doubt about it. And now, even with lower growth rates, the market is tagging Apple with a forward price to earnings of 29 times. So the forward PE of the S&P 500 large cap is around 18.6 times. And Apple is clearly of better quality than the average S&P 500 company. But I'm not so sure I'll call Apple a great bargain right now. So I do think Apple's valuations today have already priced in a fair bit of expectations and would probably hope for a greater margin of safety before entering into the stock. So if you want to know our valuations of Apple today, do head over to our blog at piranhaprofits.com, where we'll be furnishing our assumptions and also our valuation model for your reference. So the link will be in the description box down below. Now, moving on to Amazon. So they've already been on a steady uptrend, experiencing a more than 60% appreciation on a year-to-date basis. Fundamentally, we can see their business turning around the corner and coming out gradually from their investment cycle some quarters ago. At its lowest point, Amazon was delivering negative $25 billion in free cash flow on a trailing 12-month basis. Yes, you have heard it right. Negative $25 billion in free cash flow back in Q2 of last year. So in the latest quarter, operating income is up 132% year on year. Free cash flow has also finally swung back to the positive. And in my opinion, we will see explosive growth on the bottom line for Amazon in the coming few quarters as they continue to optimize the cost structure and also exit from the heavy capex spending era. However, there is an ongoing drama currently between Amazon and also the FTC, which is the Federal Trade Commission, and Lina Khan, who happens to be the head of FTC, seems hell-bent on making a case to break Amazon up. So at least for now, it does seem like many of the lawsuits launched against Amazon are theatrics at best. The market is definitely not buying it. Moving on to Amazon's valuation. Let's admit it, it's a tricky business to evaluate. Many investors might be turned off by Amazon's current price at first glance. Forward PE of 63 times, price to free cash flow of 183 times. So who in the right mind will own this stock? But at more than $1.4 trillion in market capitalization, clearly many investors still want a piece of it. So I think we have to look at Amazon's price on two fronts. First, when we look at Amazon's historical valuation patterns, they were never cheap to begin with. In the better part of 2014 all the way through 2021, they were trading in the range of between 35 times to 100 times price to free cash flow. So at the lows, it was still less than a 3% free cash flow yield. Second, you can see that Amazon tends to experience such wild swings in their valuation, also because their bottom line tends to be very noisy. So to illustrate my point, this is the historical PE and price to free cash flow chart of Amazon. In a good year, they can be profitable, and in a bad one, they can swing to the negative as if they're a startup. So the bottom line is this. You have to form an opinion on the real bottom line profits Amazon is able to deliver as they continue to build up their cloud, their advertising, their commerce services. Another realistic way is where some investors will use a sum of the parts valuation model to evaluate this giant of an enterprise. In our opinion, we do find Amazon competitively priced with a slight margin of safety for investors that are currently interested. So this is of course based on our current assumption that Amazon is going to recover strongly soon. Now, pivoting over to Microsoft. Microsoft, it's a buy. Just kidding. 3 words do not constitute an analysis. But long story short, Microsoft is probably one of the strongest businesses that we have seen in this decade. King of software, a portfolio across hardware, software, gaming, cloud, and even AI now. So some will see investing into Microsoft as being equivalent to buying into an ETF, an exchange-traded fund, due to its diversified nature. A notable event that continues to plague Microsoft is the overhang on their intentions to buy over Activision Blizzard. So Activision is one of the world's most valuable gaming company, and Microsoft wishes to acquire them at $68.7 billion. So the original deadline for this merger is 18th of July 2023, but we are well into mid-September, and it still looks as if it's not going to be completed anytime soon. So they were met with a series of challenges, from legal to regulatory hurdles, and I hope the best for them in overcoming said obstacles. That said, Microsoft acquiring Activision will not make or break the investment thesis of Microsoft. Therefore, I would not even be too concerned over it to begin with. So if I can hazard a guess, the only reason why many investors are having second thoughts about owning Microsoft today is purely because of their valuations. So if we pit Microsoft against its FANG counterparts, you can see that they are definitely trading in the premium range. So I think this is not to say that Microsoft is not worth a buy today, because it is clearly a wonderful business. For investors that have a really long-term mindset and can sit through the thick and thin with Microsoft, you can probably take a nibble at it, but not go all in at current valuations. As history has shown, there will always be unforeseen circumstances that hit your portfolio of companies, whether you like it or not. And if you have made the assessment that many of these problems and challenges are short-term in nature, then those dips would definitely be a good time to continue adding to the position. As someone who loves a good bargain, I would like to buy Microsoft when it has a bigger margin of safety, but it will definitely be on my watch list. So we've covered 3 of the Magnificent 7. If you want our opinion on the rest, namely Google, Facebook, Nvidia, and Tesla, comment part 2 down below and we'll come back with more. Remember to stay subscribed so that you'll be updated about our latest video once they drop. So this is CK from Piranha Profits signing off. Till next time, keep winning.